Wall Street appears to be in a holding pattern on this Monday as we await a two-day meeting from the Federal Reserve. Well, let's get more from Hugh Johnson. He's the Chief Investment Officer at Hugh Johnson Advisors. So, Hugh, let me figure out from you which camp you're in. There are some people who say that they want the Fed to come out and say that they are thinking about removing some of the extra stimulus. Then we got other people who say we don't want them to say anything. Let's wait until the fall. Which camp do you fall in?
Yeah, I don't really think it matters. I think really what matters is that they're very careful about how they word what they're going to do. And when I say very careful, they don't want to send a message to the financial markets that Federal Reserve policy is going to start to, let's call it, lean toward restraint. That seems to imply that not only they're going to start to reduce the securities that they're buying in the financial markets, but also that they're going to raise interest rates. So they want to be very careful to word it very carefully. And the reason they want to do that is because they're still not where they want to be with regard to the employment numbers. We still have 3.6 million fewer people or more unemployed now than we saw at the beginning of the pandemic. And until we start to narrow that gap, they're not going to be interested in leaning towards restraint, raising interest rates. So they want to be very careful not to send too strong a message to the financial market. So I don't mind them saying something about maybe thinking about tapering in response to the strong inflation numbers that we're seeing. But they want to be very careful that they don't imply that Federal Reserve policy is now changing towards restraint.
When it comes to your fingers being on the pulse, given that the S&P 500 is, let's just say it's at a record high, right? We're just a little bit off of it. The Dow and the Nasdaq not too far from their record highs. When you talk about your finger being on the pulse, is the finger on the sell button or the buy button based on what happens on Wednesday?
It's probably going to stay on the buy button so long as they are careful about what they say. So when I say it's going to be on the buy side, I don't want them to tell me or to send the message to the financial markets that they're going to start to lean hard towards restraint. And by that I mean, really, quite frankly, is that they're not going to start to raise interest rates. There's going to be a time for that, but it's now still, in my judgment, too soon. So I'm still on the buy side of things. I think the market is fairly valued. I think it's got some upside potential, particularly because the earnings numbers not only are coming in good, but they continue to be revised a little bit higher. We see economic forecasts for 2021, 22, and 23 being revised higher. So we're headed in the right direction, not strongly in the right direction, but in the right direction. And I don't want to see that interrupted by the Federal Reserve making a stronger than expected statement.
So we are in the final weeks, the final throes of the first half of the year, and you're talking about some more potential to run higher. So what are you looking at in the second half of the year? Another 5%, another 10%? Like what?
That's the right number. In the second half of this year, based on my crunching of the numbers, we're looking at about a upside potential between now and the end of, well, let's say the average for the fourth quarter of about 5%, and between now and the fourth quarter of 2022, about 11%, which is a lower number when we talk about returns. So I'm looking for positive returns from the markets, but it's not going to be galloping returns, very high returns like we saw in 2020. And again, this assumes that we don't get any big surprise from the Federal Reserve on Wednesday or at any time.
And which sectors do you think are going to lead that? Because we've seen like this seesaw thing, right? First it was value, then growth, then back to value, then growth. You got the SPACs, throwing stuff in here, and you got Bitcoin going up and down. So what's the sectors that are going to lead?
Conway, I think we got a sneak preview 2 weeks ago, maybe it was 3 weeks ago, but I think 2 or 3 weeks ago on what you're going to see when we start to get through this. And I think what you're going to see is, first of all, the economy is going to be in the process of slowing. The growth rate of earnings is going to be in the process of slowing. It'll be a little bit slower in 22 than 21, and the same thing about 23. That means the individuals are going to start to buy those companies that can produce very predictable, good earnings and cash flow. That means I think what we're going to do is we're going to go back to growth stocks. We're going to go back to communication services, consumer discretionary, technology stocks. And I hate to say it, but some of those names that drove the markets in 2020, and that's the Amazons, the Microsofts, the Googles or Alphabet, and the Facebook. So I think that's where we're going to go. It's going to take time, and those are growth stocks. And we're going to go back there, but I think it's going to take time before everybody wakes up and realizes that the economy is slowing, going to continue to slow, the growth rate of earnings is slowing, going to continue to slow, and investors are going to want those companies that can provide predictable earnings, consistently predictable earnings, and positive cash flow and strong cash positions on their balance sheets, and those are the ones that'll do it.
Great. That is Hugh Johnson. He is the Chief Investment Officer at Hugh Johnson Advisors. I'm Conway G. Gittins, and this is Reuters.